I'm sure we are all familiar with the concept of income tax, a fee that is charged by the government as a percentage of money earned by individual citizens of the nation. Income tax is paid normally out of a person's salary, and one of the things that tends to happen is, although your income tax is drawn from your salary, there are particular circumstances that apply to each individual that determine what they should actually be charged as income tax. So you may work in a particular job and earn a particular salary, and that salary is taxed at a certain level within the organization. But then every year you're required to claim for the allowances and deductions that pertain to you to determine what your actual taxable income is and what the tax payable on that taxable income is. And that calculation is what we will look at now. Each of these calculations will begin with what is called total assessable income. Total assessable income would be the accumulation of all the income that is earned for 1 year of work. That total assessable income is what tax is going to be applied to, but not all of it. In other words, your tax is a percentage of your income, but not all of your income is going to be considered when the tax is being calculated. There's a part of your income that is, let's say, non-taxable, and the non-taxable portion of your income is made up of the total allowances and deductions. And as we look at examples of these questions, there will be a chart provided with information on the various allowances and deductions, and the ones that apply to you in your circumstance will be totaled together and subtracted from your assessable income, because this portion, total allowances and deductions, is not taxable. So when you take out the allowances and deductions from the assessable income, you are left with what we will call your taxable income. Now, the taxable income is what the tax will be applied to, and as I said, the tax is applied as a percentage of that taxable income. The taxable income is not one single the tax that's to be paid is not one single percentage that is charged to the lump sum of taxable income. What happens is the taxable income is divided up into brackets. The first bracket is up to $50,000. In other words, if your taxable income is any figure that is $50,000 or less, then all of it will be taxed at 12.5%. However, if your taxable income were a figure larger than $50,000, what would happen is the first $50,000 out of that, let's say for example it was $75,000. Let me just use an example for now. Let's say the taxable income when you had done your entire calculation came to be $75,000. What you would say is, on the first $50,000 you have to pay 12.5% of $50,000, and that is going to be added to the amount that is in excess of $50,000. your taxable income is $75,000. That is more than $50,000. That is $25,000 in excess of $50,000. The excess is paid for at 33.5%, which is 33.5% of $25,000. And you would solve these two percentages and get a total. The total would be equal to your tax payable. Okay, so let's see if we can work our way through an example of this. Let's take this scenario. Mr. Bob, who is 33 years old, had an assessable income of $70,000 in 2018. In that same year, his wife had no income of her own and he supported her. Mr. Bob, who has medical insurance, paid medical expenses of $9,000 for an eye operation in 2018, and in that same year he also paid trade union dues of $310. Mr. Bob's employer deducted $12,000 from his salary as income tax in 2018, and Mr. Bob is now preparing his income tax return and has collected the following additional information to assist him in doing so. Before we look at the information as provided, notice that you are being supplied with specific details about Mr. Bob's situation, because we are doing the calculation for his income tax return, and the details that are listed we must pay attention to, because we will draw information from them to know what figures we are to apply in the calculation. So continuing, the allowances. There's a personal allowance of $25,000 and a spouse's allowance of $3,000. Now, a personal allowance applies to every person who's filing for income tax. A spouse's allowance is an allowance you can apply for if you are married or you have a recognized partner with a common law, or who is not working and you are supporting them. Therefore, Mr. Bob's scenario, it actually says that his wife had no income of her own and he supported her. Therefore, when we are doing our calculation for what his taxable income is, we will know that the spouse's allowance is included in the non-taxable portion of his income. As it pertains to deductions, medical expenses, if 40 years and over, $750 is the maximum amount you can claim for, and trade union dues, $240 is the maximum amount you can claim for. Now we're going to use this information to calculate Mr. Bob's taxable income, and then we'll use that information on the taxable income to work out the amount of tax Mr. Bob is required to pay. Mr. Bob's taxable income is going to be found by starting with his total assessable income. According to the information provided, Mr. Bob's total assessable income is $70,000. From this $70,000, we are going to establish how much of that is non-taxable. In other words, what are the total allowances and deductions. As we said before, he is going to receive a personal allowance, so we can include that from the get-go. Also, based on the fact that his wife had no income of her own and he supported her, he can also claim for a spouse's allowance. So that's another figure that is added to his non-taxable income. As it pertains to deductions, the deductions listed are medical expenses, if 40 years and over, $750 max. Our scenario tells us that Mr. Bob has medical insurance and he paid medical expenses of $9,000 for an eye operation. Now, $9,000 is way more than $750. So the most he could have claimed for is $750. But there's another factor to consider. The deduction only applies, medical expenses deduction only applies if the person is 40 years and over. Since Mr. Bob is only 33 years old, based on the information provided in the question, he cannot claim for medical expense deduction. Therefore, we would not include $750, $9,000, or any other figure pertaining to medical expenses. As it relates to trade union dues, there is no age requirement, but there is a upper limit for the amount that you can claim for trade union dues. So even though Mr. Bob paid $310 in trade union dues, the most that he can claim for is $240. So his total allowances and deductions is the sum of these figures, which gives us $28,240. Which means this $28,240 is the non-taxable portion of his assessable income. Therefore, his taxable income would be equal to $70,000 minus the non-taxable portion, or minus the total allowances and deductions, which equals $41,760. So he receives, or he earns, a total assessable income of $70,000 for the year, but because of his own total allowances and deductions, the portion of his income that is actually going to be taxable is $41,760. Since Mr. Bob's taxable income is less than $50,000, it makes the tax payable calculation all fit into one bracket. All of Mr. Bob's tax will be paid for at 12.5% because it is essentially $50,000 or less. It is less than $50,000. So 12.5% of $41,760. So please note, if we had done the calculation, or if his assessable income was a lot more, which would have made his taxable income a lot more, and it had exceeded $50,000, we would be adding a second bracket. But given that his taxable income is less than $50,000, there's only one bracket at which he's taxed, and he's taxed 12.5% of whatever the taxable income figure is in the particular equation. So this gives him a tax payable of $5,220. The third thing that we must be able to do in these questions is not just find the taxable income and calculate the tax payable. We must also be able to input the information into the income tax return form. So a table is often provided, and there are spaces to be filled by the person who is completing the form. If you notice in this particular example, the line 427, which says total assessable income, already has in Mr. Bob's total assessable income of $70,000. The next line, 428, asks for his total allowances and deductions. From our calculations, that would be $28,240, and we would input the figure $28,240 underneath $70,000 in line 428. Line 429 requires the taxable income, and it even instructs you to subtract line 428 from line 427, which is what we did in our calculations. And we got a taxable income of $41,760. So that figure will be input at line 429 for the taxable income. The tax payable on taxable income, line 430, would be the figure $5,220 that we calculated when we were going through the steps of the calculation. That figure goes at line 430. There's no special taxes, so at line 431 you will see that there's a zero figure input there already, which means that taxes payable, the sum of line 430 and 431, is going to be the same $5,220, because you're adding $5,220 plus 0 gives you $5,220. Income tax deductions. This figure actually comes straight from the question, the scenario. It says that the employee deducted $12,000 on Mr. Bab's behalf as income tax. That $12,000 goes in line 433. And that means the total credits would be $12,000, because again you're adding $12,000 and $0. So line 436 would be $12,000. And then finally we come to the last figure that must be input, and it will be input either in line 437 or line 442. At 437 we read net tax payable, and it tells us to subtract the line 436 from 432, and if 436 exceeds 432, enter the excess at 442. Otherwise, enter here. Line 442 is what's called an estimated refund. Just to make sense of what these two figures are, your employee, as I mentioned at the very beginning, has been deducting and paying on your behalf income tax out of your salary. However, at the end of the year, let's use Mr. Bab as an example. Let's say the employer had been deducting $1,000 a month, which totaled to $12,000 for the year, to pay on Mr. Bab's behalf to ensure that he had paid his income tax. What we have just calculated based on Mr. Bab's particular circumstance is that $12,000 is not the amount he was meant to pay in income tax. Rather, he was to pay $5,220 in income tax, a figure that is less than $12,000. The difference between the amount he is supposed to pay and the amount that has already been deducted by the employer, that difference is now going to come back to him as a refund, which is why it will be input at line 442. A scenario where the value would go to 437 would be one where the amount the employer has been deducting on your behalf is less than the amount that we calculate that you're supposed to pay, and therefore at the end of the year you still have what is called net tax payable. So let's use the same $12,000. If the employer had been deducting $12,000 on your behalf, and when we do our calculation it turns out that you are supposed to pay $12,600 in income tax, then that $600 difference is now what is called a net tax payable, and it is money that you are still due to pay to the government as income tax.